how to pay zero in taxes. In today's video, I'm going to talk about how to potentially be able to pay zero to Uncle Sam. I'm going to talk about ways to minimize your tax bill. And even if you cannot get your tax bill to zero, hopefully some of these tax strategies can help you get as close to zero as possible. So let's get started. One of the most simple ways to reduce your tax bill, and this is if you have a business or you're self-employed, is to buy a vehicle that's over 6,000 pounds. When you buy a vehicle that's over 6,000 pounds, the IRS lets you take a tax deduction. This tax deduction used to be 100% of the vehicle value, but like about a year or two ago, they changed this law to only cover up to $30,000. Even though it got greatly reduced, it can still help you lower your tax bill. Let's say you're on the market to buy a vehicle and you're gonna buy a big SUV. And you were gonna buy an SUV that was 5,900 pounds. But you also like this other SUV that's 6,100 pounds. If you wanna get a lot more tax benefits, you would just go for the one that's 6,100 pounds. That's because when you get over the 6,000 pounds, then you get the IRS tax deduction. This tax deduction, like I mentioned, is gonna be around $30,000. So what does this mean? This means that if you were gonna pay taxes on $80,000, if you choose to buy this vehicle, your tax bill is gonna get reduced to only paying taxes on $50,000. You're gonna save about $5,000 to $6,000 just by buying this vehicle. However, it doesn't make sense just to buy this vehicle just for the tax deduction. If you're gonna buy a big SUV for family reasons, for business, then at that point, it makes sense to buy this vehicle. But just going out there and buying a big SUV, big truck for work, just to get the tax deduction is not worth it. But there's a lot of people, especially self-employed, people that run their own business, that are looking at buying a big vehicle. And this would be something to pay attention to. Because like I said, if you're deciding between vehicles and you like them all the same, and now one of them weighs over 6,000 pounds, then I would definitely go for that option. So you can get this tax deduction. Another great way to lower your tax bill is just by buying a primary residence. Not a lot of people talk about this, but the mortgage interest that you pay on your primary residence, the home you live in, is tax deductible. And depending on the loan amount, that might be a $20,000, $30,000, $40,000 tax deduction that you get almost every year. So that is a great tax deduction that not a lot of people talk about. For example, let's say you buy a property for $500,000 and the mortgage is $4,000. A month, you're gonna be paying about $2,500 to $3,000 in mortgage interest, especially at the beginning. So what does that mean? That means that that amount is tax deductible towards your tax bill. Let's say you made $100,000 and you buy a property that's $500,000. Let's say the mortgage interest was $40,000. Now you're only gonna pay taxes on $60,000. That's gonna help you greatly, especially since you were already gonna buy a property. This is one of the big downfalls of renting because you don't get any of these tax benefits. And as a property owner, it lets you get more tax deductions, and at the end of the day, it makes you have more money in your bank account. Because money you don't pay the IRS is money you're saving. Or, like a lot of people like to think about it, it's money that you're making. So buying a primary residence is a great way to not pay as much in taxes. The third way to pay less in taxes, and this is the best way in my opinion, is to buy real estate investment properties. Not properties that you're gonna fix and flip because the tax bill is even higher on those, but properties that are gonna be long-term rentals. When you buy a long-term rental, the IRS lets you take a lot of tax deductions. They let you deduct the cost of repairs, they let you deduct taxes, they really let you deduct almost everything. One of the only things that is not tax deductible when you buy a rental property is the down payment. The down payment is never tax deductible. There's two ways to really maximize your tax deductions when you buy an investment property. And that is to get a large loan amount. That way the interest is high, the mortgage interest, so you get to tax deduct that whole amount. That's one of the ways. The second way is to buy a property that has a high building value. Why is a property having a large building value so important? That's because you get to deduct about 3.5% a year of the building value. Not at the purchase price, but the building value. Because the IRS says that every 27.5 years, the property is gonna have to be fully replaced. So they let you take about a 3.5% deduction every year. So those are the two best ways to maximize your tax deductions. Get a large loan so the interest is higher, or buy a property with a large building value. because that's where you get depreciation from. Another strategy is to buy a property that needs a lot of work. Let's say you buy a property for $50,000 and you have to put $150,000 to fix it. When you go and do your taxes, you're going to be able to reduce all the repairs against your income. This is going to be very beneficial. Now, if you buy a property for $200,000, the deductions are just going to be the mortgage interest and the legal fees. But if you buy a property that needs a lot of repairs, you get to deduct the repairs, and if you refinance, then you get to deduct the mortgage interest of the new loan. And when you refinance, the money you get is tax-free, because money from a loan is not taxable, which means that if you refinance at $200,000 at a 75% LTV, then you're gonna get about $150,000 tax-free. If you just go and buy a property for $200,000 that you put a 20% down payment, you don't get the $150,000 deduction, and you don't get $150,000 tax-free. I know it's getting a little bit complicated, but if you have any questions, just let me know in the comments and I'll try to help you guys out as much as possible. So when you buy a property that needs a lot of repairs and you use your own money to repair it, you almost get a double dip tax benefit. You get the tax benefit of repairing the property, and when you refinance, you get all that money tax-free, and now you're gonna get the deduction on the new loan of $200,000 of the mortgage interest. So in a way, you get three benefits. You get to deduct the amount of money you put to repair the property, you get the mortgage interest on a larger loan, and you also get the money from the refinance tax-free. So those are three big benefits of buying a property that needs a lot of repairs. Now, a lot of people don't want to do this because dealing with contractors and dealing with construction can be very hectic. And a lot of people that are already busy doing the regular job, they don't have time to be running construction on a property. So a lot of investors just choose to buy properties that are rehab. And it makes sense. It all depends on what you want to do. For some people, it's gonna make sense to buy a property that's fully rehab. And for other people, it's gonna make sense to buy something that needs a lot of repairs. Everything comes back to your personal situation. Now, I'm going to talk about advanced depreciation. This is what a lot of people talk about when they talk about buying investment rental properties. What is this and how does this work? There's a tax law that says that when you buy a property, you can depreciate 7 years in advance of that rental property. Now, those 7 years in advance get depreciated of the building value, not of the purchase price. If you buy a property for $400,000 and the building value is $200K, then the depreciation is going to be based on those $200K. A lot of people just talk about purchase price, and either they don't know what they're talking about or they just want to sell you a program. Either way, it's wrong. The value is based on the $200K off of that example. Now we're going to continue with this example. Let's say a property has $400K purchase price, $200K building value. Let's say you bought this property and you make $100,000 a year from your self-employment job or your W-2. So we divide 1 divided by 27.5, which gets us a percentage of 0.036. And then we multiply that by 7 because we're going to get 7 years in advance. And then we multiply that number by the building value, which in this case is $200,000. So if you bought this property and you make $100,000, that's what you're going to get taxed on. You get a tax deduction of about $51,000. This means that if you bought this property and you did a cost segregation study or 7 years in advance depreciation, then your tax bill for that year is going to be $49,000. Now you can see the big benefits of doing this strategy. This strategy has its own cons. If you sell the property early, then you're going to have to pay this money back. So it's not all rainbows and sunshines the way people want to make it seem. Yeah, you get this big depreciation, this big tax deduction, but if you sell early, then at that point you're gonna have to pay this back. Now people are gonna make the argument, well, I'll sell the property and I'll 1031 exchange into another property. You can do that, but the same thing, you're deferring the tax, and you could defer the tax until the day you die, and then once you die, the tax bill gets erased, and now the people in your family get it without ever having to pay taxes on the properties. You can do that, that is the strategy, but for the common person, they're either gonna sell, they're gonna do something with the property. So I just wanna let you know that if you do sell early, then you're gonna have to pay this tax bill or pay part of this back. and that is called recapture. Another big way to pay less in taxes or pay zero in taxes is to invest into your business. If you're self-employed and you have a construction business, it would be very smart to invest into it, run marketing ads, maybe buy better machinery, make the business more efficient, because all the money you put into your business is tax deductible. So you can have a great year and put a lot of money into your business and make it even better. That is also, in my opinion, one of the best ways to not pay taxes. If you have a business, just put it into that business, make it better, make more money. Now, if you're a W-2, then it's more tricky because you cannot really invest into your business. If you have a W-2, you can start a side hustle, or you can spend enough hours doing real estate activities throughout the months that you qualified as a full-time real estate professional. Once you do that, then all the property tax benefits can be taken against your personal income, which is ideally what you want. Another big way to just cut your tax bill is to use loans. When you use a loan for business purposes, then the interest on that loan is tax deductible. That could be for a rental property, that can be for credit card. If that purchase was used for business, then at that point that interest is tax deductible, and that's going to lower your tax bill. So if you're thinking of buying a truck that's worth $100,000 cash, maybe it's better for you to get a loan. You get the tax benefit if it's over 6,000 pounds of the 30,000 tax deduction, and the interest you pay on that loan is also tax deductible. So think about it. Getting that loan is gonna help you get the interest to be tax deductible from your income. That could be a big help. If you make a strategy, you could potentially get your tax bill all the way to zero. The last thing that I'm gonna talk about is that to pay zero in taxes, you gotta be very disciplined. If you spend a lot of money on clothes, on shoes, on vacations that have nothing to do with your business, then all that money is not tax deductible. So on top of already wasting a lot of money on shoes, clothes, vacations, cars that are not over 6,000 pounds, you're also gonna have a very big tax bill. So at that point, it's a double negative. You spend a lot of money and now you got a big tax bill. So the biggest key to pay zero in taxes is to be very disciplined with your money. The money you make, you're either gonna invest it back into the business or you're gonna buy a rental property. Both things are not sexy. The sexy thing is to go and buy nice clothes, to go on vacations, to buy a very expensive car. That's the sexy things. But when you do that, you get a double negative. And when you're disciplined and you put your money back into your business and back into real estate, then your tax bill is zero or as close to zero as possible.